You're listening to Conquering Retirement with Annuity FY. Real strategies, real stories, no sales pitch. Join Tom Hamlin and his expert guests so that you can make smarter moves faster. Hit that subscribe button and let's conquer retirement together. I need to like blow my nose, and if I mute myself, you won't obviously put that in the show. You'll just cut out that my video at that point, right?
Abby, first clip in the podcast episode.
We got 3 of the 7 dwarfs, and we got Sneezy, we got Dum Dum and Doc. Okay, let's roll it. Let's talk.
Hi, Tom. Hi, Brian.
Hello.
How are you guys today?
Meg.
Yeah, it's great to see you.
Nice to see you.
Yeah, you guys, I have a question today before we get into it. We've been talking a lot about guarantees, but I think that we need to kind of go backwards a little bit, just rewind, and kind of get into the weeds, the details about what the guarantees actually mean. We've actually had a lot of questions come through to our team directly asking, okay, you guys have talked a lot about guarantees, but what does that mean for me? What does that mean for me and my partner or my children? And yeah, I think that we could absolutely go into more detail about those. Don't you guys think?
Oh, I think we can.
I love that question as it pertains to annuities, because there's very few guarantees in life in general, as we all know, right?
And real quick, before you get into it, I'm just going to, in case people are listening to us for the first time or watching us, I just want everyone to know who you are. Tom Hamlin was just speaking. Tom's been in the industry for 35 years. I work with him every day. I've had the privilege of working with him for 13 years.
So nice.
He knows everything that has to do with an
Her
S
nose
with
just got
2
bigger, by the way.
vertical lines down the
He's the
middle.
goat.
So he's a wealth of knowledge, and we love having him here. We love having him be our expert.
Thank
and
you.
we also have his protege, Brian Hamlin. I get to work with Brian every day, yes. And Brian is also a wealth of knowledge. He's on the front lines every single day. And you guys are just a really great team to work with. I'm Meg Odermatt, and I'm the host. And I will help moderate these two.
13 years at Somerset, by the way.
Yeah, thank you.
Just like 13 minutes. Underwater.
There you go.
Working with
That's
her.
true. Yeah. Oh, whoa. I was assuming. Okay.
Meg sells herself short. She keeps the ship afloat.
Thank you. Thank you, boys. And I certainly try to.
She keeps us going in the right direction.
And I certainly try to on these shows as well, right? Yeah.
Yes.
Okay. So I interrupted you before, Tom. I'm very sorry, but I just wanted to make sure everyone knew who you were. So you were about to go into the importance of guarantees and what that actually looks like for a couple, an individual, an estate, heirs, etc. Do you want to go ahead and take it away?
All right. So there's only, when we were growing up as children, most of our parents uttered the phrase that there's only 2 true guarantees in life, and that is death and taxes. And we're all familiar with that, probably 99% of the people watching this podcast. In addition to that, however, there are 2 additional guarantees, and that is the federal government and government agency obligations like FDIC that most of us are familiar with. Treasuries are the primary government. FDIC is an agency. There are other agencies. And that there's still, there's an asterisk next to that guarantee that says subject to the underlying credit worthiness and claims paying ability of the federal government of the United States and the incredible printing press, which is really digital these days. Most people don't realize there's only $1.6 trillion of actual real money in circulation, which is a pittance of the net worth of the country and our assets. The other one is insurance companies. So the general accounts of the insurance companies are considered a guarantee. Those are the annuity contracts and insurance policies that are issued without a prospectus. And they are also subject to the underlying claims paying ability of the respective insurance company and their claims paying ability, as well as the state guarantee fund that all of the insurance companies that do business in the state chip into. And there's 53 of those, 50 states, 3 territories, U.S. territories. So that being said,
Oh, go
Those are
ahead.
true guarantees.
Can I ask you
And
though, what is the guarantee itself? That you won't
Yes.
lose money, or
Yep.
what are they guaranteeing?
well, an annuity is a contract. It's a policy, it's a contract with the insurance company, and they're contractually obligated to fulfill that contract. So, to the best of their ability. And then that's where it gets into, so that's a guarantee in of
So what
itself.
you're saying is it just depends what kind of annuity you purchase, correct?
100%. It, like
Okay.
Tom said, it's a contract. So in that contract, it's going to spell out, you are one party and the insurance company is the other party, and they're going to make, certain promises to you. We will pay you X amount per month. That amount may increase by X percentage per year if there's inflation protection. We guarantee you're not going to lose your principal. We guarantee you this certain interest rate. So that's all going to be spelled out in a contract. It's a legally binding document. And when you're talking about the guarantee, well, the first kind of natural question is, who is offering this guarantee? What is your word worth? Because this is backed by, like Tom said, the claims paying ability of an insurance company. So it's just like, life insurance. If, the breadwinner of a family passes away and they have life insurance, and now that family needs the payout from the policy so they can continue their lives. It's the same exact guarantee that's being made with an annuity. It's backed by that claims paying ability of the insurance company. So you want to make sure you have a company that their guarantee, when they say we're guaranteeing something, there's a lot of backing behind that, a lot of assets behind that, strong claims paying ability. It's like, if someone says, you loan $20 to two of your friends, one of your
Lua.
friends.
I just learned
Um,
today on, well, this is probably a quick plug for
we're
Founders Podcast. Jensen Wong, he has a word that he says at his meetings when he feels that somebody's not getting to the point, they're not being concise, and he wants 3 points out of that, which is, just package it, make it quick, and get to the point. And he'll say that word at his meetings, and people know exactly what that means, and then they have to reframe what they're doing and get to the point very quickly.
Yeah. So
So
if
that
he
was a
says
little
Lua,
joke there.
he's telling me to shut up very nicely and wrap it up.
Uh,
And if I say
wrap it up.
Lua,
Not shut up, wrap it up. Yeah.
then it's kind of the same thing.
And if I
Um,
say Lua, that means let's move it along, boys, right?
Yes.
yes.
Okay.
Yes.
So with
So,
that being,
so we were saying, we're
Talking about
talking about,
guarantees.
yeah, well, so in the history of the insurance industry, which goes back to before this country was a country, because there was a lot happening here before 1776. There's very few instances of anyone ever losing any money within the general accounts of any insurance company. And we've got maybe one or two right now where some people's assets are frozen until they figure things out, or they've done partial releases. But I got in this industry when quite a few insurance companies were failing, and then we didn't have any for many, many years. Even in 2008, we didn't have a single insurance company failure. A lot of people have to say, "What about AIG?" And I say the I stood for international, not for insurance, and it was the credit default swaps that got them into trouble. But at the end of the day, that was a profit center for the U.S. taxpayer. We don't get a lot of those. It was about $57 or $8 billion that the taxpayer profited from that. So lots of banks failed, though, over 1,000. And I don't know the exact number off the top of my head, but I'm sure we could pull it up on AI from the beginning of '08 to the present. There's been way over 1,000 banks,
Yeah.
so that should tell you something. People put their money in the bank all day long, and they have the peace of mind in knowing that they're going to get their money back, and that insurance companies are the other side of the scale there. So that's a guarantee. And when you're planning for your retirement, I would imagine that you want to feel safe, have peace of mind, and have backed by strong guarantees with consistent income. And
well,
don't
can
say
I?
Louis yet. I would say,
Okay.
I jotted this down. There's no such thing as too much peace of mind or too much safety. There's no
Sure.
such
So
thing.
with that being, that's a great quote, Tom. But with that being said, I would like to try to get into like a real world example. what's guaranteed and what's not guaranteed. So if I myself am purchasing a fixed indexed annuity with a guaranteed lifetime income product, what is actually guaranteed in that contract and what is not? Can you kind of go into that with me?
The payments at issue. So in other words, we looked up some numbers, and I think that, let's just say that somebody's 50 and they waited until they were 60 to receive that income. And I'm going to just pull it up here really fast. Takes just a second.
Oh, he's running a
And
quote, live quote.
okay, live quote. This
Live
is how
quote
quickly we
in
can
the
do
hole.
it. 50, 10 years of deferral.
Well, while he's doing that,
I'm not 50, by the way. Let's just make that clear. So I'm not.
Well, while
Yeah,
you're doing
fine.
that, Hammy, I'll just what's guaranteed in something like that, Meg, FIA with a
Yes,
guaranteed lifetime
thank
income
you.
rider, your payment is going to be guaranteed, typically.
Wow.
Thank you.
You're guaranteed not to lose your principal in that you have an account value, and you will not, it won't go down if the market
Based
goes
on
down.
market performance.
Yes, but
it will go down with payments.
in Lua fashion, and to keep things concise for our viewers, the main thing we're looking at with an FIA with guaranteed lifetime income is that income, your payment is going to be guaranteed. And if you wait a certain period of time, it's all those income numbers are going to be guaranteed. You know exactly what you're going to get on day one. There's no kind of speculation there. It's laid out in the contract.
Yeah, and then
So,
Tom, you can go ahead with your number, and then I
get
might
a load of
go
this.
ahead and
This
jot
is,
down what's not
I'm glad I
guaranteed.
didn't say anything, because this is much, much, much higher than I
Load
thought,
of this
by as much as 50%. And we run these numbers all the time. Imagine being 50, and your goal is to retire by 60. And so now you're really focusing on your retirement and how you're going to provide for yourself and your family and your sustenance and your lifestyle in the future. Imagine investing $100,000. And for perspective, and I always offer to send this out, well, not always, but when I do, I'll say it again. There was an article from 1999, the Prince song, Party Like It's 1999. Wall Street Journal article had to do with the Monte Carlo simulation theory and talking about sustainable withdrawal rates. And in order to be able to take out, provide for a 30-year retirement, you can take out 4% per year, adjusted for inflation, back, roughly 3% increases, COLA, cost of living adjustment, and you still only have an 88% chance of success. And that's if you put 80% of your money in equities. Okay.
Yeah.
That's shocking. So people, what do you do if you're real conservative? Well, here's your answer. Put in $100,000 instead of 4. How about 15,155? That's 15.16% interest guaranteed. A decade later, you're not even old enough to
For
collect
one
Social
person,
Security.
correct?
Yeah, for one person. And we could do joint for fun, but literally, if somebody put in $1 million, they have $150,000 of guaranteed lifetime income. That article that we're happy to send to anybody who would like to receive it says that 4% means 40,000 per million, and that million is pre-tax. That's depressing. Here, that million will generate 150,000 for life. If you can wait until 62, 18,221. That's 18.22% at 62 when you could start to collect Social Security.
Well, let's kind of talk about what we just heard there. Because Meg and I were speaking with a colleague, and what was it, Meg? You work your whole life, you build up $1 million in assets for retirement, and now you can withdraw 4% of that per year. That's 40,000, and you have your son or daughter who just got out of college, and they're making more than you. And this is after you've worked your whole life.
Yep.
I can't remember who said that to us. I can't remember the name.
I don't know, but it was a pretty profound conversation.
But it's right. It's like
wait, what was it? I'm
so
sorry.
you work your whole life, right? You build up $1 million in retirement assets. Now you can withdraw 4% of that per year. That's $40,000, and your son or your daughter,
what you've worked your whole life for.
Yeah, your son or daughter who just got out of college is now, they're making $50,000, right? And that's just kind of, you're happy for your child, of course, but gee, you worked your whole life. You have $40,000 a year to show for it now in retirement.
I think it
And
just shows like the sustainability. Like if you
Yeah.
want your money to be sustainable, that's what the reality looks like.
Yeah. So now let's
Right.
compare it to your
and it,
quote. I mean, so you said that same $1 million of retirement assets. How much would that get you in guaranteed lifetime income,
uh,
Hammy?
15.16%,
So
10 years later
150,000 after
at
how long?
60,
At
10 years.
60. So
50,
okay.
60, 10 years of deferral,
Okay.
generating 15.16%.
So we're using big round numbers, but the point is that if someone's planning ahead, they can set some money aside for the future. And with that quote, you said whatever they put aside today, they'll get 15% of that back per year starting in 10 years. And that's
Right.
guaranteed. And can they outlive that?
No, it's
Is that
guaranteed as
now
long as,
is that a guarantee in the contract, or could the insurance company just decide, well, we don't want to pay you anymore?
well, way to serve it up close to the net. That's an easy one to spike there, Hammy. It's contractually guaranteed. They
Oh,
cannot change it. They can't get out of it.
they
It's
can't.
contractually guaranteed. You can put that one in your vault, your safe, your
Okay.
safety deposit box.
Okay.
So,
Um,
yeah, I just want to talk about, because we're kind of making sure we're covering all of the bases. I had
Yeah.
asked a question, what's not guaranteed?
Yeah.
So it's not guaranteed.
What's not guaranteed is
the
going to
internal performance of the account value.
What does that mean?
That means that if you do the old Ben Franklin, take a piece of 8.5 by 11, draw a line down the middle. On the left-hand side, you have account value. On the right-hand side, you have guaranteed minimum lifetime withdrawal benefit. The guaranteed minimum lifetime withdrawal benefit is exactly that. It's guaranteed. And it's going to provide this income. And by the way, I ran joint. So it's 15.16% for single. It's 14% for joint. A pair of 50-year-olds, one of them at that is probably going to live over 40 years. 40 years of payments at that level. And then, so you've got 10 years of deferral, 30 years of lifetime income. That's astounding. Wait till 62, it's 17% for husband and wife, age 50, deferring to 62. 17%. That means that you can take other aspects of your portfolio and
Lua.
invest it in the market as a hedge against inflation, not subject to the sequence of returns. Louis, yourself.
That's not the question she asked.
I just want to make sure
Yeah.
we're covering all of our bases for the listeners, guys.
No, that's good.
Yeah.
What's not guaranteed in a fixed index annuity with a guaranteed lifetime income rider?
The account value, sorry, Meg.
You're going to have
it.
a cash value in the account, and that's going to go up based on market performance. There's a basket of index options that you could choose from. There's various indices that you can invest in with the cash value, and if those don't perform, then you won't be earning interest in that with that specific cash value. You won't lose anything if the market goes down. Because there's a fee typically with these products, but you won't lose based on the market. But yes, that cash value performance is not guaranteed.
And I'll tell you that the easy way to see the guarantees versus the non-guarantees are when your advisor, that could be Tom, that could be Brian, that could be anyone on our team, runs you an illustration for a fixed indexed annuity reflecting any kind of deferral period, 1 year, 5 years, 10 years, 15 years. There will always be a guaranteed page, and that
Exactly.
assumes zero performance. So that is your worst case scenario about when your account value will go to zero. What that means is why that's important is if you're looking for what your heirs will receive, you can see about how long the cash value will exist in your contract.
Yes.
Then you have the non-guaranteed pages where the hypotheticals and the historical performance comes in. But it's all based on the rates that the company is issuing the contract
Yes.
at.
And I'll also say really quickly, we talk about this cash value performance isn't guaranteed. Well, what does that mean for me? Well, if the cash value doesn't perform, let's just say we're going off that guaranteed values, it doesn't earn any interest whatsoever. It just means that the death benefit on the annuity is going to draw down faster than it would otherwise. Your income is always going to be guaranteed for the rest of your life. And the primary purpose of something like this is living benefits. But there's kind of that additional kicker with the performance is that, hey, if I were to pass away X amount of years down the road, then a certain death benefit may be left for my heirs. And that is going to be dependent on the performance of the account.
So for perspective, most people are familiar with immediate annuities. That's the oldest definition of an annuity. It goes back to Roman times, so maybe even earlier. You would turn over a sum of money to the empire, and they would pay you a monthly stipend in exchange. But you no longer had that lump sum that you turned over to the empire. In this case, you turn over a lump sum to the insurance company, and this is the oldest definition. They pay you out on a SPIA, a single premium immediate annuity, or a deferred immediate annuity, which we have referred to for many years as the oxymoron annuity. Um, because they're opposites, obviously. If you give your money to an insurance company for a DIA or a SPIA, you no longer have a lump sum of money. You have a promise to pay in the future, which is very inflexible. If you do what I the numbers with a fixed indexed annuity with a guaranteed minimum lifetime withdrawal benefit, by the way, they haven't been around very long. 16, 17 years. That's it. The FIAs have been around for 33 years or so. I know I was there. And the guaranteed lifetime withdrawal benefit aspect of them really took over when GMIBs went away in 2009. They picked up the baton that fell on the ground and they started running with it. So this is the new latest example of guaranteed guaranteed lifetime income. Back to Meg's original question, you still have control of your principal with a fixed indexed annuity with a guaranteed minimum lifetime withdrawal benefit. You can still see your account value. It will be growing during the deferral period, and it will be shrinking during the payout period because these payments are so massive. But if someone deferred a year and started taking out income, that income is going to last 12 or 13 years. And with an immediate annuity, you're usually buying life with 10. And so this is already better. You still have control. You have a bigger payment. And I ran quotes on a deferred immediate annuity, 14,267. That's $1,000 less, 900 less than the fixed indexed annuity with control. And if you decide with the DIA that you want to retire in 9 years or 8 years or 7 years, can't do it. You got to wait 10. If you decide you want to leave it alone longer, let it continue to gestate for 11 or 12 years, can't do it. With the fixed index annuity, you have complete control and you can turn on the income whenever you want. So you have more control and you have a bigger payment, and that's called having your cake and eat it too.
Well, you guys, I think this has been great. I did want to cover some other guarantees, but we can certainly save that for another episode. I think that there's so many guarantees to talk about, and there's so many details to go
So
over with
many.
annuities. What'd you just say?
I said so many,
Oh, yeah. Okay, sorry.
so
Um,
many.
so many. So I think that we could actually cover those in a future episode, and that one will be just as detailed and hopefully educational as well. Do you have any parting words, Tom
I
or
I
Brian?
definitely do, of course. So, one thing I want to impart upon everybody is that this is temporary. Like most things in life, they're fleeting, and this is not going to be the case in 12 months. I've actually been saying that for a while because I expected rates to come down faster than they have. But when Powell is out on May 23rd from the chairman's role at the Fed, I believe that rates are going to drop rapidly. I've said that in the past. I've said, that I think they're going to go down 50 to 125 basis points on the first time that they meet. We'll see if I'm right. But these rates won't be here because they're predicated on buying bonds. That's what insurance companies do with your money. They buy bonds. And right now, as the short end of the yield curve has been going down, the long end of the yield curve, it continues to steepen. And it's the optimal time to get involved with these products. Do it now, the only moment of which you ever have any control.
Brian, any parting words?
Look at the guaranteed values on your illustrations. If you're
So
looking at,
how do they get an illustration?
you gotta
Gotta
contact,
know somebody. We gotta know
you gotta
somebody.
know a guy.
But guess what? They know us, right?
Yep.
You guys, if you're listening to us, that means you know us. So
Yeah,
you can
reach out.
always reach out to us. You can put a comment in the comment section if you have a generic question, or if you want to contact us, or you can go to our website, which is annuityfy.com. There are several ways to reach us there.
Yeah.
There's also a ton of educational resources there.
Yep.
But yeah, if you want to contact us, we can run personalized quotes for you at any time. And as Tom said, these rates are changing. So, we can't always, when you're listening to this, they might be higher, they might be lower. They most likely will be lower if you are watching this, in the future.
They're not going up.
But so reach out to us. At least you'll
Yeah.
know what you're working with, right?
Well, yes, and if you've stayed and watched, through this whole thing, we thank you. We really appreciate it. And just to give you a little bit about what that looks like, if you submit an inquiry, then it would be either myself or maybe Meg or maybe Derek who will reach out to you to just learn a little bit more about your situation. And ultimately, we can, have a discussion and get you an illustration. Or if you want to call in, then just call in. And once again, could be any of us that pick up the phone, and we're happy to learn a little bit first about, what you need and your goals, and then get you ultimately an illustration and walk through this kind of stuff with you. Of course, if you have someone trusted, that's the most important thing. But if you feel like you need a
But
resource,
you can trust us.
please reach out. Yes.
Yeah, it's always good to have a second opinion, right?
Yeah.
It's
One
always
last
good.
thing is diversification. And we're not saying put all your money in these. We're saying put a portion of your money in these because it's the guaranteed portion of your portfolio. It's the foundation of your proverbial skyscraper.
So until next time, guys, thanks for joining us. And
Thank you.
Listen,
See you next time.
watch, subscribe, go to our website, contact us. Thanks, boys.
Thank you.
Goodbye.
Thanks, Meg.
Bye-bye.
Thanks, Brian.
That's a wrap on this episode of Conquering Retirement with Annuity FY. Ready to take control of your future? Call 1-866-223-2121 to speak with one of the guests on our show and get your questions answered today. Visit annuityfy.com for more information and to contact us online. Follow the show and make sure to turn on notifications so that you'll never miss a tip, strategy, or breakthrough moment.